Walter Begich, the third editor of The Economist, noted in his book Lombard Street that the Bank of England's directors allowed the bank's reserves to fall rapidly from the autumn of 1857. The bank was in the midst of a very severe crisis that year. In the middle of September 1857, the news of the collapse of the Ohio Life Insurance and Trust Company reached London. After this, the United States stopped the export of coins to England. These events, which were not seen as serious enough by the directors of the Bank of England, were followed by the suspension of bank payments in Baltimore and Philadelphia. By now, bankers in London realized that something serious had happened. The events forced the Bank of England to raise its discount rate to 6%. The bank's cash reserve ratio declined rapidly in the early days of November, forcing it to again increase its discount rate to 8%. At this point, several large firms and one or two provincial banks in England collapsed, which increased the demand for loans. The country's banks stopped lending money to strengthen their position and increase their deposits with the Bank of England. On the other hand, the cash resources of the Bank of England were falling as the export of coins from the US had stopped and the rates of coins on the European continent were rising. The Bank of Hamburg, one of the world's oldest surviving banks, was in the midst of a crisis. The Bank of England was forced to extend the use of its credit. On the 5th of November, the bank again raised its discount rate to 9%. The situation became more alarming after several business failures and the collapse of the Western Bank of Scotland. The Bank of England's reserves were rapidly draining and its liabilities towards banks' deposits were increasing. The joint stock and the private banks of England stopped discounting, and from the 9th of November, the entire demand for loans and discounting bills fell upon the Bank of England. On the 11th of November, the City of Glasgow Bank suspended operations. For 4 days from the 9th of November, the Bank of England loaned £5 million to the public but failed to subdue the prevalent panic. On the evening of November 12, the bank's liability for deposits stood at £13 million, while the cash reserve in its banking department was just £581,000, an amount that could have been exhausted by a single cheque presented to the bank. At this critical moment, the bank management informed the government about the state of affairs. The government responded by giving a virtual authority to the issue department to issue notes backed by government securities. This empowered the banking department to transfer securities worth £2 million to the issue department. In return, the banking department received notes, which were placed in its reserves. The issue of excess bank notes was in contravention of the Bank Charter Act of 1844, an Act of Parliament. The Act of 1844 was hastily suspended between Wednesday evening and Thursday morning. On Thursday, the ministry assured the bank that if it acts illegally by issuing notes in excess, it would ask Parliament to protect the governor and company against any loss arising from the execution of such act. The government letter to this effect was published in The Economist on the 14th of November, 1857. The letter signed by the First Lord of the Treasury and the Chancellor of the Exchequer stated that while it is important to maintain the letter of the law even at difficult times, such a measure as is now contemplated has become necessary, and they rely upon the discretion and prudence of the directors for confining its operation within the strict limits of the exigencies of the case. The action of issuing notes against government securities might have seriously endangered the convertibility of notes. Public fears were allayed by the assurance of the bank's ability to extend loans. Since business activity and commercial payments largely depended on the supply of loans and bank discounts, the assurance of the Bank of England instantly allayed the panic. Following this, other banks in England resumed their operations. The crisis finally ended through this moral relief given to the public. Charles Dunbar, professor of political economy at Harvard University in the late 19th century, noted that the conditions on which the terms of the bank charter were abandoned were kept secret. Dunbar explains that the bank was required to hand over to the government all the profits made from notes issued above the statutory limit. The bank was also asked to raise interest rates to help it return to the legal limit of the issue. It may be asked, why did the government help a private bank sail through the crisis? The answer lies in the importance of London, and later of New York, as a big financial centre. In England, the country's banks depended on the Bank of England, while in America, banks relied on the banks of New York. In Britain, there was a concept of sliding discount rates to discourage banks from excess lending. In America, such banks were first asked by the controller of money to fill up their reserves within 30 days or wind up their business. Another important point worth considering is the separation of the issue and banking departments under the Bank Charter Act of 1844. This great idea made the operations of the Bank of England almost mechanical and transparent, as the issue department could gain nothing by issuing more notes. It was a very progressive approach to make banking operations honest and subject purely to the market demand for loans. This, perhaps, was the reason why the bank didn't intervene when its reserves were depleting since the autumn of 1857. The separation of the issue department from the banking department was first proposed by the English economist David Ricardo in his pamphlet, Plan for the Establishment of a National Bank, first published in 1824. The Bank of England's focus was to ensure the continued credibility of the bank. The Bank of England was a private corporation separate from the government. It was managed by its officers and was responsible to its shareholders. Hence, its primary end was to earn dividends for its shareholders. Begit noted that the bank greatly improved its policies after the crisis of 1857. The history of banking in England is closely associated with the country's politics. Since the Middle Ages, the country was dependent on the Jews, the Lombards, and the Hansards, or merchants of the Hanseatic League, for its commerce and finance. These foreign merchants and moneylenders often provided loans to the English kings. In England, the concept of banking as it is known today emerged only after the 16th century. The Exchequer was established in the 13th century AD. It started as a repository for cash and evolved into an office of accounts. During Henry III's reign, money-lending bankers, primarily Jews, operated in Oxford. The expulsion of the Jews from England in 1290 led to a significant shift in the private banking sector. The Lombards, who had been sent to England by Pope Gregory IX, took over the banking business. After the Italians, England's goldsmiths conducted the banking business. Lombard Street, London's banking hub, was named after the Lombards and foreign merchants who gathered there twice daily. Goldsmiths were esteemed members of the finance community in London and held prestigious positions as early as the 12th and 13th centuries. Goldsmiths' Row, which was noted for its beauty, was later destroyed in the Great Fire of London in 1666. This led the city's goldsmiths to relocate to Lombard Street. The surplus money of these goldsmiths was placed at the Royal Mint in the Tower of London for security and convenience. However, in 1638, Charles I withdrew approximately £200,000 from this as a loan, which ruined many bankers. Although the amount was repaid within months, the Royal Mint's credibility suffered lasting damage. The first recorded bank run in England occurred in 1667, which led to a widespread panic among depositors. Banks, or the goldsmiths with whom the money was deposited, attempted to restore confidence by requiring a 20-day notice for withdrawals, but their credit was ruined by 1672. The tradition of depositing the surplus money of the country's bankers in the mint ended after Charles I's withdrawal in 1638. This led to the practice of depositing funds in the Exchequer instead. Customers' demands were met by withdrawing this money once a week. On January 2, 1672, King Charles II, in dire need of funds, followed Sir Thomas Clifford's advice and halted the payments to the Exchequer. This way, Charles II stole £1,328,526 from the Exchequer. This led to widespread financial ruin for bankers and their customers. Charles assured the bankers by agreeing to repay the principal amount at 6% interest. While interest payments were made for a few years, they were eventually suspended. As a result, creditors had to take their claims to court, leading to a judgment against the Crown. The goldsmiths, who were the country's bankers, issued notes or acknowledgements of deposits, which passed freely in the country. The value of these notes was more than the money deposited. They also discounted foreign bills and made huge profits from this. The discount rates were high as traders themselves benefited greatly from speculation as price fluctuations were very high. For example, the price of saltpeter, a component of gunpowder, rose greatly during war times. A trader who had prior knowledge of the arrival of ships laden with saltpeter from the East Indies might calculate his profits in advance and make investment decisions accordingly. In 1694, the government adopted a plan proposed by William Paterson, an adventurer from Scotland, to offer a loan for public subscription in return for banking privileges. After this, the Bank of England was established under the Act of 1694. The Act mandated a voluntary loan of £1,200,000 to support the country's war against France. The War of Grand Alliance, or the 9 Years' War, began in response to France's invasion of the Rhineland in 1688. The alliance was led by England, the Austrian Habsburg, and the United Provinces of the Netherlands. The sum of £1,200,000 was subscribed at 8% within a brief time. The dividends were supposed to be paid from interests paid by the government, from the discount of bills, and from the profit made by issuing credits. The bank was authorized to deal in coins, bullion and exchange, and lend money against security. It was not permitted to borrow or give security by bond, bill, or agreement beyond its capital limit. It was prohibited from trading in merchandise. Commissioners were tasked with collecting subscriptions. The stockholders of this fund were called the Governor and Company of the Bank of England. The bank was prohibited from lending money to the Crown without Parliament's approval. On January 1, 1695, the bank began operations at Grocers' Hall in Poultry. It started issuing £20 notes and began discounting mercantile bills of exchange. The bank had to suspend payments in 1696. Following this, the bank was granted a banking monopoly in the kingdom and was allowed to issue notes payable to the bearer on demand. The bank's capital was doubled, and interest on the same was reduced from 8% to 6%. In 1707, fears of a French invasion led to panic and renewed calls for the bank's dissolution. However, support from the Queen and influential lords helped the bank survive the crisis. The bank's monopoly was confirmed by the Act of 1707. In 1717, the South Sea Company went through a significant collapse, leading to a panic that caused a run on the Bank of England. The bank managed to navigate this crisis effectively. By 1722, a reserve fund known as the Rest was established to provide financial stability. During the late 18th century, private bankers in London introduced blank checkbooks for customers, which became widely adopted. This innovation replaced bank notes and challenged the Bank of England's monopoly on banking. During the final years of the 18th century, the threat of a possible French invasion of England sparked widespread panic, leading to bank runs across the country that eventually reached London. On February 26, 1797, the Bank of England was instructed to suspend cash payments until Parliament could assess the situation. Despite the bank declaring its financial health, Parliament continued the suspension of cash payments for 6 months until a peace treaty was finalized. From 1800 to 1810, banknotes experienced gradual depreciation, primarily due to overissuance. By 1814, the maximum depreciation reached 25%. In 1813, the number of country banks rose to 900, but within 3 years, 240 such banks closed. The Act of 1833 permitted companies and partnerships of more than 6 persons to open a bank in London or within a radius of 65 miles. These banks were not permitted to issue notes. The London and Westminster Joint Stock Bank was established in 1834, and many more banks issuing notes began operations outside the prescribed limit. However, this led to numerous commercial crises. This resulted in the passage of the Bank Charter Act of 1844, or Peel's Act, named after the Conservative Prime Minister Robert Peel. Peel introduced significant reforms to the country's banking system. These measures led to the separation of the issuing and banking departments of the Bank of England, removing its control over the issuing department. The 2 departments were required to have separate accounts. Following the passage of the Act, the convertibility of banknotes was never called into question for many years as the public had no demand for the coins lying with the issue department. In a sense, the issue department could gain nothing by increasing the issue of notes. Thus, the Act of 1844 made the bank almost flawless and the demand for money subject to the mechanical forces of demand and supply. The Act also restricted the establishment of new banks of issue in the UK and put a limit on the number of notes that the existing country banks could issue. Only the Bank of England could issue notes within the 65-mile radius of London. In the 19th century, the bank established branches in big cities like Manchester, Liverpool, Birmingham, Bristol, and Leeds. By 1888, there were 173 joint stock banks in the United Kingdom. The banker's annual license fee at that time was £30. The first clearing house was established under that name in 1773 in London. Later it got a building in Lombard Street in 1775. The clearing house facilitated easy exchanges of checks, drafts, banknotes and evidence of indebtedness between banks. In May 1864, the Bank of England joined the clearing house and began money exchange and transfer operations without bank notes or coins. Each banker using the clearing house was required to have an account with the Bank of England. The transfer of accounts settled balances due at the close of each day. By the end of the 19th century, many of the largest trades in the world were settling their accounts in London. The world's supply of gold was distributed from the city, and many lending and payment operations by other countries were taking place through it. Walter Begich explained in his book Lombard Street, a description of the money market, that all English banks depend on the Bank of England, and all merchants depend on some banker. Lombard Street is to say that it is by far the greatest combination of economical power and economical delicacy that the world has ever seen.